What is going on, everybody? Welcome back to another video. In today's video, we are going to go over when to buy and sell options and why. So with that being said, let's go on ahead, jump into the intro.
I know I'm fine, but the money
Guys, this is a very it's gonna be kind of contradicting to a lot of people, and when I became a new trader, it really was too. So the one thing I want to go into is, and I want to show you a chain first. And when I say chain, I mean the options chain. For any of you guys that don't know this, because we trade a lot of options, and when I mean trade a lot of options, we sell a lot of options based off of the math. That's really what we do. So we're gonna go over here to options, and this is the Qs. I like the Qs a lot, but we always want to go to straddle. So we can see both sides of the market, because I think that's pretty important, to be honest with you. And I just want to show the difference here, because this is a trade that I personally took, and it worked out just fantastic. So first thing we're going to do is we're going to look at the overall market here. Coming in last week, we absolutely just got hammered here at the beginning of the year. So what was my positioning thinking? Well, my first thing is I am worried there is going to be a rough Q1 result. So I'm jumping in bullish. But when a trade presents itself, I'm 100% going to take advantage of it. So on this massive red day right here that we had, and this massive gap down, I told myself, even though I'm not bullish on the overall market at the exact second, I'm bullish long term, but not the exact day. I sold a put. Now, why would I sell a put? So why would you sell a put on a red day is the main factor here. And the simple answer is you're going to collect more premium. So the odds of it bouncing back after a big red day or after a couple of red days is much better, and those premiums will shrink up way faster. And what do I mean by that? So I'm going to show you here this Qs trade here. So if you sold a put, and these are way too close, if I was going to do this, I'm going about 40 days out, 45 days out into the Qs, so we're probably looking at February 16th. And you're going to see all of a sudden you're going to get a lot more premium out of these. And that's the bigger difference here. So I'm not looking at doing any of these $700 ones, $600 in premium. That's not what I'm looking for. What I'm looking for is I'm going to go out of the money quite a bit on a put, but I am going to collect probably roughly $250. I think what I collected was more than that because of the circumstance I was in. So what happens is when you come down to the options is when they have red days, means the option value goes up. Basically, if it goes against your option that you're selling, obviously it's going to show that you're losing money. But I'm going to sell that premium on those red. Just like if I was going to sell calls, today would have been the day I am selling calls into this massive green day that we had today, up to a little over 2%, which is a good day on the S&P or the Qs, the NASDAQ. So that's exactly what I did. Was I sold last week on this massive red day, and then I sold another one on this day. I didn't sell anything on this day, and I remember this very clearly. And then nothing really happened on Friday. Didn't really kill me or anything. My positions really didn't move a whole lot. They just weren't going down still, which I liked. And then boom, they popped today, and I took all mine off at 25% winners today. I was very, very happy at a short trade and taking them off at 25% profitability, or basically 25% premium collected. And I think that's a massive thing people don't understand is we're not just trading options, we're selling options. I'm building the edge into my trades. Probability, law of large numbers. If anybody in here is an insurance agent or anything like that, you'll know that. That's exactly what we are doing. But I'm basically going against the grain. And that's why I said at the beginning of the video, a lot of people, it's the opposite of what a lot of people tell you to do. Is again, you got to make sure they're good companies when running the wheel strategy. But selling options on days when it's going against the grain. So every time I get big red days, I'm selling options on those stocks. Every time I get big green days, I'm taking those trades off for large amounts of profit normally. So I think that's something that a lot of people hesitate about, and they will continue to sell puts on these green days. I don't love it. And my biggest reason why is, look at the charts. Even when there are massive green legs up, there are days afterwards where you get, a couple percent down move, which to me is fantastic, because that tells me, oh, it's an opportunity. I think this is bullish long term. I'm going to sell that put because I'm okay with getting it assigned. And that's really where you start the wheel strategy, is getting assigned. But a worst case scenario is you don't get assigned these options unless a black swan event basically happens. If you don't know what a black swan event is, it's just a once every like 15 to 20 years. It's one of those things that you just, it is what it sounds like, a black swan. Swans are normally white. It's black. You never see one. It's once in a blue moon thing. So that is the basis. Again, if you're selling calls, well, I'm looking for those massive green days, and then I'm going to sell calls against them. Me, I don't sell a lot of calls unless it is a covered call. Again, today on the stocks that I owned, like SO and KO, I did sell covered calls against today, and I'm assuming either I'm going to do very, very well on them, or I'm going to get them taken away from me, which I'm okay with, but I'm also okay with keeping them. And I think that's a key point in the wheel strategy that not a lot of people are comfortable with. You have to be comfortable with owning some shares in good companies. I think that key word is those good companies I keep coming back to. But that's where it comes down to. And again, this is exactly all you got to do. And whatever stock it is, if you're on Robinhood, you're just coming to trade options. This will tell you how many days this is right here. I'm going out to as close to that 45. So on this one, I'm going 46 days. Some of you may like that 39 days better. I'm going to sell. I'm going to sell a put. And then I'm going to go get a 20 delta. So probably going to be about right here, I imagine. Oh, that's a 24. Surprise there. The delta 22. That's close enough to me. Here we go. That's close enough to me. I'm going to go sell that. And again, as long as I have the shares, and I don't have them in this Robinhood account, but I have them in my TD Ameritrade account, if I like it, I'm going to sell the option against it. But this is a put, so I just have to have that collateral. Or I can go buy, or I can go sell the call. On a covered call side, all I'm doing, oh, I messed that up. That's 100% on me. I'm going to go the exact opposite way. I'm going to come up here, but on calls, I do go to 10 deltas. That's just my preference. That's a 12. That's an 8. I would rather go up to 12. I'm going to collect a little bit more premium, and I'm okay with getting them assigned when it happens, because I'm going to make the difference here, which is quite a bit, 404 to 430. Yeah, I'm more than okay with making that difference, plus keeping my premium collected of $120. So with that being said, guys, thank you guys all for watching this video. I hope that helps somebody else out. Don't be afraid to sell options or sell puts in particular when the VIX goes up and there is some volatility in the market. Premiums will get higher, you'll collect more, and then when the market continues to go up like it seems to always do, you're going to make profit faster. So with that being said, thank you guys for watching. I will see you in the next one.